At 2:43 p.m., the baht snapped. For 3 seconds, the currency barely moved. Then it plunged. Screens blinked across Bangkok. Dealers hesitated. Phones rang without answers. And somewhere, far from the humidity and jasmine of Siam, a trader smiled. He had placed the trade days earlier. Quietly, calculated, ruthless. $1 billion, leveraged, hedged, aimed directly at Thailand's central illusion, that its baht was invincible. It wasn't. In the halls of the Bank of Thailand, silence fell. Reserves were evaporating. Overnight rates were spiking. No one knew the full position, but everyone felt its impact, like a tremor before a quake. And yet the headlines remained calm. Thailand was not at war, but its currency was under attack. The trader didn't drop bombs, he didn't rally troops. He opened terminals, issued orders. Watched the flow of dollars against the fiction of stability. By nightfall, $2.3 billion had left the country. No tanks, no invasions. Just capital in retreat. Faster than any defense could intercept. The irony? Thailand had been the darling of the East, a model of growth, a miracle economy. Its towers kissed the sky. Its people believed the future had arrived. But beneath it all, debt, illusions, and a currency pegged to the dollar like a child gripping a tiger's tail. And now the tiger turned. What followed would destroy billions in equity, plunge millions into poverty, and rewrite the economic order of an entire continent. But it began here, with a single man, a single trade, and a single truth. The day $1 drowned a kingdom. Southeast Asia was soaring. In the 1990s, the world called it a miracle. Thailand, Malaysia, Indonesia, their economies surged at breakneck speed. Annual GDP growth hit 8, 9, even 10%. Foreign investors poured in. Skyscrapers climbed out of rice fields. Roads cut through jungles. Bangkok turned electric. To Western analysts, the formula was simple. Cheap labor, export-driven growth, rising urban consumption. The Asian tigers roared and Wall Street cheered. But behind the confidence, a fault line widened. The region's currencies, including Thailand's baht, were pegged to the US dollar. Fixed exchange rates promised stability, predictable returns, no surprises. Except the world doesn't stay still. As the US dollar strengthened in the mid-90s, Thailand's competitiveness faded. Exports slowed, debt accumulated, loans, often dollar-denominated, ballooned. And as capital flowed in, asset prices disconnected from reality. Bangkok's skyline became a mirage, cranes frozen midair, buildings without tenants, glass towers rising from unpaid foundations. Banks lent freely, often recklessly. Real estate boomed on air. And still the government insisted all was fine. The peg was sacred. The reserves were strong. Confidence was everything. But in the background, foreign debt rose above 100% of GDP. Short-term liabilities outpaced liquid assets. And the Bank of Thailand quietly defended the peg, burning reserves faster than it admitted. The world didn't see it. Not yet. Headlines stayed bullish. Reports called the slowdown temporary. But bond traders noticed the spreads. Hedge funds watched the current account deficits. And one man in London began to run the math. He wasn't interested in GDP forecasts. He looked at the delta, the unsustainable divergence between belief and balance sheet. Everyone else saw a miracle. He saw a time bomb. And when the first cracks appeared in the Thai banking system, he didn't flinch. He prepared to light the fuse. In 1997, Bangkok was a dream under construction, and a delusion in motion. From the sky, it shimmered. Towers of mirrored glass pierced the monsoon air. Airports expanded. Highways stretched toward the horizon. At ground level, the story changed. Traffic choked the streets, cranes stood idle, and construction sites littered the city with silence. For nearly a decade, Thailand had basked in prosperity. GDP growth averaged over 9%. The baht was pegged to the dollar, creating the illusion of safety. Investors, Japanese, American, European, dumped billions into property, stocks, and bonds. It was a bet on Asia's future. But the engine was debt. Thai banks borrowed dollars abroad and lent baht at home. Real estate developers borrowed millions to build office towers no one needed. Families took out loans to buy condos that didn't exist yet. Foreign capital flooded in. Little of it was productive. All of it was fragile. The baht peg, set at 25 to the dollar, acted like a magnet. Investors believed the government would defend it, at any cost. That belief became the anchor of the Thai miracle. But the cost was rising. Thailand's foreign reserves were stretched thin. The central bank intervened daily to hold the line. In private, officials worried. In public, they smiled. Markets react to fear. And fear in a fixed currency regime is fatal. Warnings came, softly at first. In March, a local finance company collapsed. In April, the capital inflows slowed. But Bangkok still partied. Magazines still ran Asia's rising tiger spreads. The Prime Minister gave speeches about unshakable fundamentals. The reality was different. Behind the glass, Thailand was cracking. The real estate sector was overbuilt by 40%. Non-performing loans were rising. The current account deficit widened past 8%. And the government was running out of foreign currency to defend the impossible peg. But the myth persisted. Thailand was too modern, too strategic, too beloved by investors to fall. We are too strong to fall. They believed it. So did the markets. Until one trader proved them wrong. He didn't look like a threat. Not to a country, not to a currency, not to an empire. He was quiet, private, known for his charts, not his charm. His office overlooked the Thames. His trades, obscure derivatives and currency forwards, were tracked by few, understood by fewer. But behind the silence was obsession. He studied Thailand the way a surgeon studies tissue, not for beauty, but for rupture. Every balance sheet, every debt maturity, every central bank intervention, he mapped them all. And what he found was a system ready to break. Thailand's foreign reserves, he calculated, were overstated by at least 30%. Much of it was already pledged. Worse, the short-term foreign debt exceeded usable reserves. The peg wasn't a promise. It was a bluff. He tried to warn others, presented models, showed spreadsheets. He was dismissed as alarmist, called paranoid. One fund manager laughed. Thailand's not Mexico. But he knew. Pegged currencies don't bend, they snap. So he stopped talking and started betting. He built a position, slowly, quietly. Currency swaps, options, forward contracts. He leveraged $100 million into over $1 billion in exposure. Not all in one shot, but layered, structured, perfectly timed. He shorted the baht. Colleagues thought he was mad, betting against a sovereign state, against the Central Bank of Thailand. Madness. He called it math. The risk was existential. If Thailand had enough reserves, he'd be crushed. But if he was right, the baht would fall, hard and fast. He didn't coordinate. But he wasn't alone. A few other funds, watching the same numbers, began to follow. Whispered calls, mirror trades. One move became a signal. The signal became a storm. He knew the moment would come, when the central bank would run out of dollars, when the defense would turn desperate, when the illusion would give way to gravity. He didn't plan to collapse a country, only to test a theory that in a world of floating capital, fixed illusions can't hold. And Thailand, beautiful, booming, blind, was about to break. It began at midnight, as these things often do. The trader activated the final leg of his strategy. A series of aggressive short positions, layered through offshore accounts, aimed directly at the Thai baht. His exposure now exceeded $1.2 billion, a tidal wave of leverage pressed against a fixed wall. The first strike was precise. Forward contracts placed through Singapore. Then, options bought in Hong Kong, swaps initiated through London, and shadow positions opened in New York. The goal was not chaos, it was pressure, and Thailand felt it instantly. By morning, the Bank of Thailand noticed abnormal volumes. Orders to sell baht, matched with escalating foreign demand for US dollars. It wasn't panic yet, but it wasn't normal. Traders at the central bank were instructed to intervene, quietly, to support the peg without spooking the market. But defending the fixed rate required real dollars, not belief. They began to sell. Over the next 48 hours, Thailand's central bank burned nearly $2 billion to defend the peg. No public statement, no press alert, just silence, spreadsheets, and shrinking reserves. But the trader had calculated this too. Each dollar sold by the Bank of Thailand made the peg weaker, not stronger. Because it proved the defense wasn't automatic. It was desperate. Other funds took notice. They piled in. The attack was no longer theoretical. It was kinetic. By June, Bangkok was hemorrhaging reserves. The government issued denials. The baht is stable. Speculators will lose. But markets don't obey speeches. Rumors surged. Thailand would devalue. Thailand would float. Thailand would fall. And all the while, the trader held his position. He didn't gloat. He didn't blink. One fund in Zurich mirrored his trades. Another in Tokyo copied his structure. The bet grew, coordinated only by logic, not communication. In one 24-hour window, over $5 billion in baht was sold offshore. The Bank of Thailand raised overnight rates to 25%, then 50%, then 75%. But no one cared. The capital was gone. The trust shattered. Officials called it economic terrorism. But there was no crime, no bullet, no coup. Just capital, moving faster than a country could respond. Thailand called it treason. Wall Street called it smart. The counterstrike came with urgency and futility. By early June 1997, Thailand's central bank had already spent over $9 billion trying to defend the baht. Every day, its traders woke before sunrise, ready to sell US dollars into the market. Every night, they ended with less. Still, the government insisted the peg would hold. Official reserves were declared at $32 billion. But the trader, and now many others, knew better. A large portion of that figure was tied up in swap obligations, inaccessible, already spoken for. The true number was far lower. Internally, the Bank of Thailand faced a reckoning. Emergency meetings stretched into dawn. One plan involved asking Japanese banks for bilateral support. Another floated the idea of IMF assistance, still seen then as surrender. Interest rates spiked to 100% overnight in some transactions. Foreign investors panicked. Domestic banks faced margin calls. Liquidity dried up like rain in sand. Then came the interventions. On June 19th, the central bank cracked down on offshore baht speculation. New regulations restricted forward sales. Swaps were limited. Trading accounts flagged. Capital controls whispered. But it was too late. The traders had already moved. Their capital sidestepped the new restrictions through synthetic positions, using options, mirrored equity sales, and proxy currencies. Every barrier Thailand raised was bypassed within hours. Desperation deepened. The finance minister, Ma, under pressure, flew to Tokyo, then Washington. He returned with handshakes but no bailout. Credit lines closed, confidence collapsed. One internal memo at the Thai Ministry of Finance read simply, "We are outgunned," and the trader watched, quietly, clinically. Each counterstrike confirmed the fragility, each defense a signal that the end was near. He didn't feel pride. He felt gravity. What held the baht together now was no longer policy. It was denial. And denial has a short half-life on Wall Street. On July 1st, the Thai cabinet met in crisis. They had $1.3 billion left in liquid reserves, enough to defend the peg for perhaps 3 more trading days. The room fell silent. One man said what no one wanted to hear. "We have to let it go." And the next morning, the Bank of Thailand did. On July 2, 1997, the Bank of Thailand announced what it had denied for months. The baht would no longer be pegged to the US dollar. It would float freely. The market didn't hesitate. In the first hour, the baht fell 15%, by close over 20%, and it kept falling. From rooftops in Bangkok, you could still see the skyline, still smell fried noodles in the street below. But the city had changed. A currency collapse isn't visible. It spreads silently, through credit, through panic, through prices. Imports spiked. Debt payments tripled. Companies that borrowed in dollars now faced obligations they couldn't meet. And those who lent to them, Thai banks, foreign funds, state agencies, began to fall. The contagion was immediate. Investors fled Thailand, and then turned to the region. What about Malaysia? What about Indonesia? The same fixed exchange rates, the same fragile banks, the same offshore dollar exposure. They shorted everything. By August, Malaysia's ringgit fell 45%. The Indonesian rupiah collapsed 80%. South Korea called the IMF. Hong Kong raised rates to 300% overnight to defend its currency peg. Asia, once the miracle, was now the battlefield. Factories closed, stocks crashed, entire currencies erased half their value in days. Suicides rose, protests erupted. In Jakarta, rioters set malls on fire. In Bangkok, construction sites froze mid-frame. Thailand, once the tiger cub, was now the epicenter of an earthquake that flattened half a continent. The damage, over $600 billion in wealth erased in under 6 months. Entire generations lost savings. Political regimes collapsed. Economic ideologies crumbled. All because a few believed the illusion would hold. And one man dared to bet it wouldn't. He didn't launch the crisis, but he pulled the pin. And when the baht broke, the system followed. The empire didn't fall. It evaporated. He never set foot in Thailand. He didn't walk its streets or feel the humidity rise from the Chao Phraya River. He never met the families who would lose their homes, the workers who would lose their jobs, or the ministers who would lose their careers. He didn't have to. From an office tucked between stone buildings in the heart of London, he watched everything collapse, quietly, methodically, and with clinical detachment. He made over $700 million. No interviews, no victory laps, no triumph. Just a recalibration of his models and a short note to investors. The trade executed successfully. Funds were secure. The risk had resolved. The thesis was correct. He didn't call it profit. He called it validation. Thailand, meanwhile, was unraveling. The prime minister resigned. The finance minister was dismissed. Protests surged in Bangkok. Students poured into the streets. Teachers lost pensions. Nurses were furloughed. Millions who had believed in the miracle woke up to a market that had withdrawn its blessing. The IMF arrived quickly, with $17.2 billion and a manual written in Washington. Liberalize capital accounts, cut public spending, raise interest rates, privatize everything. And in return, perhaps stability would come back. It didn't. Not quickly. Not without pain. Shops shuttered. Imports soared. The baht, once strong enough to buy a vision of modernity, now barely bought rice. Families sold heirlooms. Landlords evicted tenants who could no longer pay in a currency no longer worth anything. But none of that reached London. The trader didn't gloat. He didn't celebrate. He remained anonymous, tucked behind layers of corporate silence. To him, Thailand was not a flag, not a culture, not a history. It was an inefficiency, a flawed peg, an open position. The global press debated his morality. Was this financial terrorism, or just smart investing? Economists split into factions. Some blamed the traders, some blamed Thailand's bubble. Others pointed to the IMF and its prescriptions that treated symptoms but deepened the wound. But in the markets, morality is not priced. Only risk is. He had simply acted first. What made him different was not aggression. It was clarity. He saw what others denied, and he moved before they believed it was possible. That was his sin. That was his genius. He didn't collapse Thailand. He just removed the illusion that it couldn't collapse. In Bangkok, they called him a villain. In New York, a visionary. In Hong Kong, a warning. In Jakarta, a ghost. His name passed through trading floors like folklore, often mispronounced, often exaggerated, but always feared. Behind closed doors, funds studied him, mimicked him. Some tried to become him. He was the proof that a single trade, executed with precision, backed by conviction, unburdened by borders, could rewrite the fate of a nation. And Thailand, for all its beauty, all its growth, all its pride, had become a line on his chart, a spike, a fall, a lesson. He never returned to the trade. He didn't short Malaysia. He didn't strike again. He didn't need to. His statement had been made. He proved that belief is not a defense, that even miracles break under pressure, that in a world ruled by capital, truth is found not in speeches but in liquidation. One man, one trade, one crack, and the kingdom fell. The aftermath didn't end in Thailand. It spread like ink in water. By the close of 1997, the Asian financial crisis had become global code. Korea requested a $58 billion bailout, the largest in IMF history. Indonesia's rupiah collapsed by over 80%, triggering riots and regime change. Malaysia imposed capital controls, shocking the world. Hong Kong defended its dollar peg with rates that climbed to 300% overnight. What began as a local currency adjustment became a systemic shock that exposed the fragility of emerging markets dependent on foreign capital and pegged illusions. The trader didn't speak. He watched the world rewrite its playbook. IMF policies were questioned. Western economic models, long exported as gospel, now looked punitive, even colonial. Nations once eager to open their capital accounts began asking new questions. Could sovereignty exist in a floating world? Could growth survive without vulnerability? China studied quietly. It saw what happened to Thailand, what happened to Korea, what happened to Indonesia, and it vowed never again. It began stockpiling foreign reserves, managing its exchange rate, limiting speculative flows. It understood that currency exposure was not just financial, it was strategic. From that moment forward, the dollar was no longer just a global reserve. It was a weapon. In the decades that followed, a new financial order emerged. BRICS formed. Sovereign wealth funds multiplied. Asian central banks swelled their reserves not out of greed, but out of fear. Fear of another raid, another run, another silent war waged in spreadsheets. The legacy of the Thai collapse wasn't just economic. It was psychological. A trust was broken. That the market was fair, that the rules were universal, that the tide would always lift all boats. After 1997, nations stopped believing in invisible hands. They began building walls. Currency no longer moved in peacetime. It was now a preemptive strike. The trader didn't return. His trade was closed, his theory confirmed. But his influence lingered, like a shadow at every central bank meeting, every exchange rate policy debate, every reserve management decision from Seoul to Sao Paulo. He had shown that a single position, properly placed, could collapse an entire economic regime. Not with violence, not with politics, but with leverage. Empires no longer fall to armies, they fall to currency. There were no parades, no treaties, no declarations, just a number on a screen blinking red. That's how the war ended. Not with tanks, but with trades. Not with bombs, but with basis points. One currency floated, then fell. One economy paused, then collapsed. Millions paid the price. And one man profited. He was called insane, a gambler, a vandal. But he wasn't wrong. He simply saw something others refused to see. That fixed illusions shatter when exposed to floating truths. Thailand wasn't broken by misfortune. It was broken by belief. Belief that the market could be managed, that the peg could be protected, that the storm wouldn't come. But storms don't ask permission, and traders don't wait. The lesson wasn't in the collapse. It was in the cause. A single bet, a simple trade, a crack in the armor of Asia's miracle. And everything fell. Today, the story lives in textbooks and testimonies. The men in suits, the models in Excel, the meetings behind glass, all trying to explain how it happened. But the truth is simpler. One man asked a question the world couldn't answer. What happens if the baht breaks? And then he made it happen. He didn't fire a shot. He just moved his capital. The empire fell anyway. Subscribe to Shadow Empires where money became warfare.